6 inches of water, that's all it took, and it came up through the floor on an ordinary Tuesday. No hurricane on the news, no river on the map, just a storm that didn't stop. By morning, the kitchen is ruined, and they do the obvious thing, call the insurer. They've paid this premium for years, they're insured, and the adjuster says the sentence that turns the whole story: "I'm sorry, flood isn't covered." Not the storm. Not the damage, the word. So here's the question nobody hands you with the bill: who pays? Risk casebook. Case file, no flood insurance. Start with the part most homeowners never check. A standard home insurance policy, the one most people have, quietly excludes flood. It always has. So only about 4 in 100 American homeowners carry flood insurance. The other 96 have no flood policy at all, most of them sure they're protected. And the trap has a second jaw. We treat flooding as a flood zone problem, somebody else's beach house. But almost 1 in 3 flood claims come from outside the high-risk zones, on streets the maps call safe. So the danger was never only the water. It was the gap between "I have insurance" and "I'm covered for this." And most people find that gap the morning it's already too late. Follow this one house, we'll take it all the way down. So ask the obvious question: a fire is covered, a burst pipe is covered, why is flood the one thing carved out? The answer is the idea the whole industry is built on. Insurance works when one person's bad luck has nothing to do with the next person's. Your kitchen fire and your neighbors are unrelated, so the unlucky few are carried by the steady many. Risks like that are independent, and the pool only holds if everyone doesn't lose on the same day. Flood breaks that rule completely. It doesn't pick one house. It takes the whole street in an afternoon, our house, and every house beside it, all filing on the same morning. A risk that big and that synchronized is more than a normal insurer can hold. So, for decades, private companies simply refused to sell it. That's why, back in 1968, the only one left to insure the floodplain was the government itself. A federal program called the National Flood Insurance Program. Hold on to that. The flood insurer of last resort, the one that steps in when no company will, is really a government program. We'll see what kind of shape it's in. Now back to our house and how fast this gets expensive. The figure is hard to believe. Just 1 inch of water through an average home does about $25,000 of damage. Our owner has 6, and there's no buying your way out now. A new flood policy takes 30 days to switch on. You cannot buy it as the water is rising. So the situation is frozen, the water is in, the policy is not, and the question stops being, is this covered, and becomes the only one this channel ever really asks: who pays? Let's keep an honest ledger and write each name as the bill finds it. Name 1 is the easiest to write and the heaviest to carry. You. With no flood policy, there's no deductible to argue and no adjuster to call back. Every dollar of that $25,000 and climbing comes out of your own savings, your own equity, the money the house was supposed to be. And for most families that cushion is thin. More than a third of Americans say they couldn't cover a sudden $400 bill, let alone $25,000. So the loss lands first and hardest on the person with the least room to absorb it. Which is the moment most people say the same hopeful thing, but FEMA will help. So let's test that hope. It's the most misunderstood part of the whole system. Name 2, FEMA. First catch: FEMA help only exists if the president formally declares a major disaster, and most floods never clear that bar. So for a lot of people, the federal grant isn't even on the table. And when it is, look closely at what it is. The headline sounds real, assistance can reach about $43,000. But that's the ceiling, not the check. The average grant FEMA actually pays is around $3,200. Let that land. Now set it beside what a flood policy would have paid out. The average flood claim runs about $52,000, and the rescue comes into focus. The government's check covers roughly 6 cents on the dollar. FEMA says so itself in writing. Its help is not a substitute for insurance. It was never meant to rebuild the house, only to get the lights back on. For our owner, that's a few $1,000s against a hole that starts at $25,000 and keeps climbing. So where's the real federal money? Here's the part almost nobody expects. It isn't a grant at all, it's a loan. The largest recovery dollars come from an SBA disaster loan. Up to $500,000 to rebuild, but it's borrowed money, repaid with interest for as long as 30 years. Name 3 wears a federal seal, but read the fine print and it routes the bill straight back to you, now with 3 decades of interest on top. And the rope has a knot in it. Roughly 2 in 5 applicants are turned down. Of everyone rejected, about 9 in 10 are refused for the same reason, poor credit, or simply too little income to repay. Read that the way it lands. The people hit hardest by the flood are the most likely to be told they don't qualify to borrow their way out of it. Meanwhile, our owner is still standing in that wet kitchen, and the bill is still moving. Step back, because the rest of the bill goes somewhere much bigger. Remember the insurer of last resort, the federal program that steps in for flood. That's where the money goes when it runs out of everywhere else. About 4.7 million policies, run by FEMA, standing on the United States Treasury. It sounds like the solution. It's really a window into how deep the hole is. The program owes the Treasury more than $20 billion, and climbing. That's after Congress simply erased $16 billion of what it owed, back in 2017, just to keep paying claims. The interest alone runs into the hundreds of millions a year, paid out of premiums first, and only when premiums fall short does the taxpayer cover the rest. Add federal disaster aid on top, funded by everyone, in every state, river or no river. So name 4 is the taxpayer, millions who will never see a river, quietly standing behind our owner's kitchen too. And inside the program's own pool, the policyholders who fund it, the bill is shared in a way almost no one would design on purpose. Name 5, the other policyholders. A tiny sliver of properties drives a wildly outsized share of the damage, homes that flood again and again. These repetitive loss properties are only about 1% of policies, but by the government's own count, they account for a quarter to nearly 40% of every claim dollar the program has ever paid. The many quietly carry the chronically flooded few, and our ordinary house, paying into the same pool, is now helping carry that bill too. So the loss isn't shrinking as it moves down the ledger. It's being passed around the room, and the room is now the whole country. Read it back name by name. 1 you, 2 FEMA a gesture. 3 an SBA loan relief you repay. 4 the taxpayer. 5 the pool. The loss didn't vanish, it got socialized, spread so thin that nobody's crushed alone. And that's the trap, because it almost looks like the system working. It isn't. The biggest payer in this whole story hasn't been written down yet. It never gets a letter, it never files a claim, and it has quietly paid more than every name above it. The biggest payer is the house itself. Think about what value even means here. A home is worth whatever someone can borrow to buy it, and lenders grow wary of a house that's known to flood. And this isn't a prediction, it's measured. One large study of flood-exposed homes finds they already sell at a discount, averaging around 9%, and as steep as 20% in the hardest-hit places. For our owner, that single cut to the home's value can dwarf the $25,000 in ruined drywall and the FEMA gesture combined. The largest line on the entire ledger, and it never sent an invoice. And for the homes the map does flag, it's sharper still. In a federal flood zone with no flood policy, the loan can't even be sold on to Fannie Mae, the giant that buys most American mortgages, so banks can keep lending. So the bank won't write it at all. No insurance, no mortgage, only cash buyers, and cash buyers pay less. Multiply that one house across the country. And economists estimate American homes carry more than $120 billion of value. The flood risk simply hasn't been allowed to erase yet. The house didn't lose a window or a wall. It lost the one thing that ever made it an asset. So go back to that wet kitchen floor. You own the house. You paid the premium. Were you ever wrong? No, but you were incomplete. Because a safe home was never just the walls and the roof. It was a quiet promise running underneath them, that your risk was shared, spread across millions of strangers in a pool none of you could see. Insurance was that promise. The flood didn't only ruin a floor, it showed that for this one risk, the promise was barely there. Nothing about the building changed. What changed is who was standing behind it, and the answer you now know became you. Here's the model to keep, long after this one house. A home isn't an asset because it has walls. It's an asset because a pool of strangers quietly stands behind its risk. Take the pool away and the walls are still there, but the asset isn't. And for flood, that pool barely exists. About 96 in 100 homeowners are outside it, and the program holding the rest is already underwater. To be fair, it isn't all doom. The cost of backing insurers runs in cycles and has eased for a while. The program keeps getting renewed, and reasonable people argue how much of this is insurance and how much is a wider housing affordability strain. But the structural fact doesn't move. Researchers estimate about 70% of the country's flood damage is uninsured. The loss is real, and the ledger always balances. The only question, the one this whole channel exists to ask, is whose name ends up at the bottom. Case file: no flood insurance closed. So tell us, what disaster, what hidden cost, what risk should we follow next? Comment the risk, the country, or the city you want traced. Subscribe for clear risk economics that follow the money after the water. The case file stays open.